Money is only as strong as the confidence people place in it, yet history shows that this confidence can evaporate in months, even days. In 1923, Germany's mark became worthless almost overnight, forcing citizens to carry wheelbarrows full of banknotes to buy basic goods. The paradox of modern finance is that currency is not backed by gold or silver, but by collective belief and stability. When that belief falters, even the most advanced economies can experience chaos, reminiscent of early 20th century hyperinflation. During Argentina's crisis in 2001, the government's dollar peg collapsed, wiping out savings and pensions almost instantly. Citizens who trusted banks and government assurances found their money's value eroding at unprecedented speed. Confidence acts as the invisible glue holding economies together, yet it is fragile and easily shattered by mismanaged debt or monetary policy. When trust fails, the mechanisms of money itself start to break down, revealing a system built on perception as much as calculation. Even the wealthiest nations are not immune. In the Weimar Republic, inflation reached 100% in November 1923, while workers were paid daily just to buy bread. The public's faith in money disappeared faster than governments could respond, exposing the raw vulnerability of financial systems. Currency is a promise, and when that promise is doubted, the social contract of finance collapses. No amount of paper or electronic accounting can substitute for widespread trust in the medium of exchange. Economic history is littered with moments when faith in money faltered, from post-WWI Hungary to Zimbabwe in 2008. In each case, ordinary people face the immediate consequences of decisions made in distant offices and central banks. Even minor policy missteps can trigger cascading failures, turning a manageable economic situation into full-blown panic. Confidence, once lost, is nearly impossible to restore without dramatic intervention or structural reform. Banking systems rely on the assumption that deposits are safe, yet crises prove this assumption can fail. During runs on banks, the abstract numbers in ledgers transform into tangible fear, illustrating how sentiment drives financial reality. When money becomes unmoored from trust, it is not just savings that vanish, but the entire rhythm of commerce. Prices fluctuate wildly, supply chains break, and the economy becomes a theater of uncertainty and survival. The lesson is stark. The stability of currency is inseparable from human perception. Without confidence, money is reduced to paper, and the complex machinery of modern finance grinds to a halt. Even in 21st century economies with sophisticated central banks, the shadow of historical collapses looms. The Weimar Republic and Argentina serve as enduring reminders that confidence is both fragile and indispensable. Financial crises rarely happen by accident. They follow a predictable pattern rooted in excessive debt and overextended credit. Governments borrow to cover spending, banks extend loans to maintain liquidity, and central banks intervene with low-interest policies that unintentionally fuel risk. Sovereign debt accumulation often begins quietly, with public borrowing appearing manageable relative to GDP. Yet small deficits compound over time, creating pressure that eventually forces currency devaluation or inflation to reduce real debt burdens. Credit expansion magnifies economic growth temporarily, but it also inflates the bubble that will eventually burst. When lending exceeds the economy's productive capacity, the system becomes vulnerable to sudden shocks and loss of confidence. Inflation is often the first visible sign that the financial framework is under stress. As governments print money to cover deficits, purchasing power erodes, and even well-intentioned policies accelerate the cycle toward instability. Banks operate on trust and leverage, making them highly sensitive to systemic shocks. A sudden withdrawal of deposits or collapse of asset values can transform minor liquidity problems into full-scale banking crises. Historical patterns show that currency crises and debt crises often occur simultaneously. When investors doubt a nation's ability to honor its obligations, capital flight and speculative attacks exacerbate existing weaknesses. Central banks attempt to stabilize economies through monetary tools, yet these measures often have unintended consequences. Interest rate cuts or quantitative easing can temporarily mask problems, but they rarely eliminate the underlying structural imbalances. The recurring sequence is clear. Debt accumulation leads to monetary expansion, which feeds inflation, erodes confidence, and ultimately triggers a financial collapse. Countries with large external obligations or weak fiscal discipline are particularly susceptible. Political pressure and short-term policy decisions often worsen the cycle. Governments may resist austerity or fiscal reform, fearing public backlash, even as economic indicators point toward inevitable correction. Banking regulation, or lack thereof, plays a critical role in these patterns. Inadequate oversight allows risk-taking to accumulate unseen, setting the stage for systemic failures once confidence falters. Reserve currencies temporarily shield nations from the worst effects of this cycle. However, reliance on foreign credit and central bank interventions cannot indefinitely substitute for sound fiscal management and public trust. Debt crises are rarely isolated. They often ripple across borders. Financial contagion can spread rapidly through trade, investment, and banking networks, turning a national problem into a global event. Ultimately, the economic pattern reveals a cycle driven by human behavior, not just numbers. Confidence dictates liquidity, lending, and investment, and without it, the entire system teeters on collapse. After World War I, Germany faced massive reparations imposed by the Treaty of Versailles, amounting to 132 billion gold marks. The government financed these payments through borrowing and money printing, creating the seeds of hyperinflation. By 1922, the German mark had lost half its value relative to the US dollar, accelerating as the government continued printing currency. Workers were paid twice daily in some regions because money became worthless almost immediately after receipt. In January 1923, the mark traded at 18,000 per US dollar, a tenfold increase from the previous year. By November, the exchange rate had skyrocketed to 4.2 trillion marks per dollar, demonstrating the catastrophic speed of currency collapse. Inflation eroded savings entirely, wiping out middle-class wealth accumulated over decades. Pensions and bank deposits became meaningless, forcing citizens to barter goods and services in daily transactions. The government initially resisted monetary reform, fearing political backlash, while industrialists demanded stabilization to maintain production. This political paralysis deepened the economic crisis, illustrating how governance intersects with financial stability. Hyperinflation also devastated the banking sector, which could no longer provide reliable deposit or credit services. Banks attempted to lend more money to sustain the economy, but the lending only fueled further inflation and currency devaluation. In rural areas, farmers initially benefited because debts could be repaid with worthless currency. However, shortages of essential goods eventually created hunger and social unrest, showing that short-term gains cannot stabilize a collapsing system. The Dawes Plan of 1924 eventually restructured reparations and introduced foreign loans to stabilize the economy. This intervention temporarily restored confidence, but it highlighted Germany's dependence on external support rather than self-sustaining fiscal policies. Price controls and wage agreements were implemented to contain inflation, yet speculation in currency and commodities continued unchecked. The crisis proved that without public confidence, even strict policies could not prevent systemic collapse. Weimar Germany's hyperinflation demonstrates the interconnectedness of debt, monetary expansion, and loss of trust. When confidence dies, money ceases to function as a store of value, medium of exchange, or unit of account simultaneously. The social consequences were severe. Unemployment rose, political extremism increased, and the economy relied heavily on foreign capital to recover. The fragility of the financial system was exposed to the public in a way that still informs modern central banking. Banking laws at the time were insufficient to prevent overextension of credit or rapid currency depreciation. Regulators lacked the authority or experience to intervene effectively, allowing the crisis to escalate unchecked. Hyperinflation also destroyed international trade confidence, as foreign partners refused to accept marks or long-term contracts. German exports initially surged because products became cheaper abroad, but instability soon undermined industrial planning and investment. The Weimar collapse set the stage for global lessons on monetary discipline and the limits of borrowing without sustainable revenue. It became a template for understanding how sovereign debt, monetary mismanagement, and public confidence interact to create crises. Even small miscalculations in fiscal or monetary policy can trigger massive economic upheaval in fragile systems. Germany's experience proved that structural weaknesses amplify shocks and make recovery difficult without coordinated reform. Argentina in 2001 faced a debt crisis stemming from decades of fiscal deficits and borrowing in US dollars. Public debt had reached $132 billion, nearly 50% of GDP, making repayment increasingly unsustainable as economic growth stagnated. The government's fixed exchange rate peg of 1 peso to 1 US dollar initially stabilized inflation, but created mounting external pressure. By late 2001, the peso was overvalued, exports were uncompetitive, and capital flight intensified as investors lost confidence. In December 2001, Argentina defaulted on $95 billion of sovereign debt, the largest in history at that time. The banking system froze deposits under the corralito, creating widespread panic and civil unrest across the country. Inflation surged after the peso was devalued, hitting 41% in 2002, while unemployment soared above 20%. Savings evaporated, and citizens resorted to bartering goods, echoing the social disruptions seen in Weimar Germany decades earlier. Political instability compounded the economic crisis, with multiple presidents in the span of weeks. This demonstrated how financial collapse and governance failures are tightly intertwined, amplifying both domestic and international consequences. Zimbabwe in 2008 presents another extreme example, with hyperinflation reaching 79.6 billion% in November. Government borrowing, land reform policies, and money printing created a perfect storm, destroying both savings and functional commerce. The Zimbabwean dollar collapsed completely, forcing people to adopt US dollars and South African rand for everyday transactions. Local banks became irrelevant as cash lost its meaning, showing the ultimate consequences of lost confidence in money. Prices doubled every 24 hours at the height of the crisis, making normal trade impossible and destabilizing the entire economy. Farmers, merchants, and laborers all suffered, highlighting how hyperinflation disrupts every layer of society. Both Argentina and Zimbabwe demonstrate the recurring pattern: high debt, monetary expansion, loss of confidence, currency collapse. These cases reinforce that confidence, not simply currency issuance, is the foundation of economic stability. External interventions sometimes stabilize crises temporarily, but rarely solve structural weaknesses. International aid, IMF programs, or foreign loans can buy time, yet underlying fiscal and monetary mismanagement often remains unresolved. Sovereign debt, once perceived as safe, can quickly turn into a trigger for a systemic collapse when confidence falters. Investors withdraw, banks fail, and governments face impossible choices between austerity and continued monetary expansion. In all three historical cases, ordinary citizens bore the brunt of financial mismanagement. Savings, pensions, and wages lost value rapidly, proving that economic patterns are not abstract. They have immediate human consequences. Even today, these case studies serve as a warning for policymakers and investors alike. They show that no economy, regardless of size or sophistication, is immune to the effects of debt-fueled confidence crises. Today, global sovereign debt has surpassed $100 trillion, exceeding 100% of world GDP, a level historically associated with heightened financial risk. Major economies like the US, Japan, and parts of Europe continue to borrow heavily, while central banks maintain near zero or negative interest rates, inflating debt burdens further. The US federal deficit reached $1.7 trillion in 2023, while total public debt crossed $33 trillion. These figures mirror the unsustainable borrowing patterns seen in historical crises, suggesting that high debt alone is not the only danger, but its interaction with confidence is critical. Central banks rely on quantitative easing and large-scale asset purchases to stabilize markets. While these interventions prevent immediate collapse, they risk creating asset bubbles and undermining long-term trust if markets perceive currency dilution. Interest rates remain historically low, encouraging borrowing but straining future fiscal flexibility. If inflation unexpectedly rises, governments may struggle to service debt without triggering financial instability, echoing past crises in Argentina and Germany. Emerging markets are particularly vulnerable, with debt denominated in foreign currencies, exposing them to exchange rate shocks. In 2025, countries like Turkey and Pakistan have faced rapid currency depreciation as investor confidence falters, showing the same debt confidence dynamic at play globally. China's shadow banking system illustrates the risk of hidden debt accumulation. Non-bank financial institutions lend extensively with limited oversight, creating potential systemic shocks if defaults rise or trust in repayment falters. Reserve currencies, like the US dollar, temporarily shield economies from immediate collapse. However, dependence on external confidence and capital inflows cannot replace sustainable fiscal policies and robust financial frameworks. Inflationary pressures are increasing worldwide, with energy, food, and housing costs rising across multiple regions. These trends highlight the fragile link between monetary policy, public trust, and purchasing power, a lesson history has repeatedly confirmed. Private debt levels are also historically high, with household and corporate borrowing exceeding 200% of GDP in some countries. Excess leverage in the private sector magnifies the risk of cascading defaults if economic confidence declines suddenly. Financial markets today are interconnected globally, amplifying shocks across borders. A collapse in one major economy could ripple through currencies, commodities, and debt markets, much like the contagion seen during the 2008 global financial crisis. Technological dependence and high-speed trading add a new dimension to systemic risk. Confidence can evaporate faster than ever before, as digital markets react instantly to economic signals and policy announcements. Public perception of central banks' credibility is crucial. Even slight doubts can trigger bond sell-offs or currency pressure. The same dynamic drove historic crises, emphasizing that trust in institutions remains as vital as fiscal numbers. The recurring pattern persists. Excessive debt, monetary expansion, and eroding confidence form a cycle that history has repeatedly proven dangerous. Without meaningful intervention or reforms, modern economies risk repeating the mistakes of the past on a global scale. If the current global debt trajectory continues, inflationary pressures may accelerate, eroding real incomes and destabilizing savings. Rising prices for essentials like energy, food, and housing could spark social unrest, much as seen in historical crises. Central banks may face impossible choices between raising interest rates to curb inflation or maintaining low rates to service debt. Either option carries systemic risk. Higher rates can trigger defaults, while low rates erode currency confidence. Sovereign debt crises could emerge in both developed and emerging markets, as investor tolerance for high leverage diminishes. Countries with large, foreign-denominated debt, weak fiscal discipline, or political instability are particularly vulnerable to sudden capital flight. Banking systems remain exposed to liquidity shocks, as depositors and investors quickly respond to perceived risks. Modern interconnected financial networks mean that a crisis in one economy could cascade globally, affecting trade, investment, and currency markets. Currency volatility is likely to increase, with exchange rates fluctuating unpredictably. Nations may experience sudden devaluations, forcing governments to impose capital controls or adopt foreign currencies to stabilize domestic economies. Private debt defaults could surge if households and corporations cannot meet obligations amid inflation or rising interest rates. Such defaults would strain banks, potentially triggering credit contractions and amplifying economic downturns. Asset bubbles in housing, equities, and government bonds are growing as investors seek safe havens in an uncertain environment. When confidence collapses, these bubbles could burst simultaneously, intensifying financial stress. Global trade may suffer as economic uncertainty discourages investment in cross-border transactions. Supply chain disruptions, price shocks, and reduced consumer demand could combine to slow growth worldwide. Political instability often accompanies financial instability, as governments struggle to balance debt obligations with public needs. Policy missteps or delays in fiscal reform can deepen crises, creating cycles of unrest and economic deterioration. Modern economies also face the added risk of digital and cryptocurrency volatility. Speculative markets can amplify shocks to confidence, triggering rapid withdrawals, devaluations, and systemic stress beyond traditional monetary systems. A loss of confidence in central banks themselves could undermine the entire monetary system. Even with reserves, tools, and liquidity facilities, perception of incompetence or mismanagement can erode the effectiveness of policy interventions. Historical patterns indicate that delayed reforms exacerbate crises. Without proactive measures to stabilize debt, restore confidence, and strengthen banking oversight, the next financial collapse could rival the severity of Weimar Germany or Argentina. Emerging markets remain particularly fragile, as they depend on foreign capital and reserves to manage debt. Rapid reversals in investment or lending could trigger immediate currency crises and inflationary spirals. Finally, the implications extend beyond economics. Societal cohesion, political stability, and global cooperation are all at risk. Financial crises are rarely isolated. They ripple through every aspect of life, reshaping wealth, opportunity, and governance. The ultimate lesson from history is that money is not wealth itself, but a reflection of trust in institutions, policies, and each other. When that trust erodes, no amount of gold, paper, or digital accounting can preserve the economy's stability. Even today, economies with the largest debts and most sophisticated financial systems are only as strong as public confidence allows. Central banks, governments, and markets can intervene, but interventions are temporary if structural trust is absent. Crises in Germany, Argentina, and Zimbabwe reveal a universal truth. Confidence is both fragile and the most critical asset in any financial system. Loss of confidence transforms liquid assets into liabilities and reduces complex economies to survival-focused transactions. Modern economies appear stable because interventions delay collapse, but history warns that patterns repeat relentlessly. The same mechanisms, debt accumulation, credit expansion, and monetary overreach, remain active, awaiting triggers that could expose systemic weaknesses. Contrary to conventional thinking, the value of money is less about fiscal balance sheets than social perception. When societies collectively doubt the integrity of currency, the system falters, regardless of numerical measures or reserves. Investors, policymakers, and citizens alike must recognize that confidence is the currency that underpins all other forms of money. Protecting trust may be more important than chasing growth, as history repeatedly shows that stability is fragile and hard-won. Even in advanced economies, subtle erosion of confidence can ripple rapidly through markets. A seemingly minor policy misstep or unanticipated shock can trigger outsized responses, underscoring the precarious balance modern finance depends upon. Ultimately, the contrarian insight is simple yet profound. Money follows confidence, not the other way around. While economies focus on numbers, debt, and growth, the invisible force of trust determines whether financial systems thrive or collapse. History offers a clear warning. No economy is immune, no reserve currency is permanent, and no policy can substitute for the foundational power of belief. Understanding this shifts the focus from chasing economic indicators to safeguarding confidence itself.